How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to look at a very interesting article from Bank Director, which basically looks at where have all the buyers gone for banks. If you're a bank right now that's out in the market and you want to be sold, it can be a little difficult right now. There's a lot of, I would say, probably picky buyers. There's fewer buyers out there, and that's really the whole point of this article. And I'm going to bring this in right here. So this article is titled "Where Have All the Buyers Gone?" This is at Bank Director, and the author of this article is John Engen, who's a contributing writer. And so he breaks this article down into a couple things. He kind of gets into the some of the difficulties with selling a bank that we'll go over in a minute. And he basically likens this like selling a bank. Why selling a bank is like selling a house, and we'll talk about that a little bit. He gets into the fact that there are fewer and pickier buyers at the moment. He asks the question: is this a trend or is this a mirage? And then finally, he kind of wraps up with some, what are perhaps some compromises and some concessions that you should be considering if you are looking to sell your bank. So, and then he rounds out the article at the end with basically, some suggestions, for basically getting a 2 or 3 year head start on the process. So let's go back up here to the top and let's jump in with where he says here. So, the board and management team of 74 million Lake City Federal Bank in Lake City, Minnesota, had plenty of reasons to begin pursuing a merger before its recent sale. The 90-year-old institution's then CEO was nearing retirement, and most of the candidates for the job wanted to work remotely from the Twin Cities, 70 miles north, or get paid more than the bank could afford. At the same time, the regulatory burdens and technology costs were getting too great to shoulder. When the other local bank in this picturesque Mississippi River town of 5,200 was acquired and started to introduce the latest in customer-facing technologies, any questions about the mutual bank's long-term future felt answered. That's when the writing was on the wall, recalls Jeff Coates, the bank's former chief financial officer, who briefly took the reins as CEO before the bank sold. We said, we truly can't afford to compete. We're better off partnering with someone who has deep enough pockets to invest in those technologies. So deciding to sell, it turned out, was the easy part. The search for a partner took longer than anyone expected and required Lake City Federal to cast a wide net across several states. In 2022, it agreed to merge with East Wisconsin Savings Bank, the $267 million subsidiary of Wisconsin Mutual Bancorp, located about 300 miles to the east and Kaukauna, Wisconsin, only to see the deal fall apart 13 months later when Wisconsin Mutual experienced capital issues. After a second round of searching, Lake City Federal finally found its match. $1 billion Forward Bank, a subsidiary of Forward Financial in Marshfield, Wisconsin. The deal was announced in January and closed in May. Today, white plastic covers draped over the bank's signature, proclaiming it a branch of Forward Bank. So, finding a merger partner was a lot more difficult than anyone here thought it would be, says Coates, who is now a Forward senior vice president. His advice to other community bankers looking for a deal today: be patient. Could be tougher than you think to find a partner, and everything will take a lot longer than you think or hope it will. So, and I think that's a very good point, and getting back, perhaps the most important part here is at the very beginning where they talk about the regulatory burdens and the technology costs. Both of those issues are massive issues on many banks today. I mean, even banks that are, approaching $10 billion still have to take a very hard look at the regulatory burden and their technology costs. So you have different hurdles in banking as you get to different asset sizes. So in other words, if you get to $1 billion, you jump just over $1 billion, you're going to have kind of a new level of regulatory scrutiny. When you get to 10 billion, you're going to get another level of regulatory scrutiny. When you get to 50 billion, when you get to 100, when you get to 250, you kind of hit these hurdles. And the problem is, I think if you go over $1 billion, it can, you can kind of find ways of dealing with that aren't too cumbersome. But one of the major ones is 10 billion. Like you can't just walk over 10 billion, get to like, 10, build 10 billion, 500 million. You really got to get up to 13, 14 billion in order to be able to absorb a lot of the regulatory costs and expenses that come with that. And that's why a lot of banks out there, you'll see they might be hanging around at 8 or 9 billion, and then they might find another bank that's maybe 4 or 5 billion, which will put them up to that 13, 14 billion mark real quick through a merger. So you'll kind of see that, as banks start to flirt with that $10 billion number. So, but anyway, I digress. Just something I wanted to point out there. So, okay, and then let's go back here. Where were we at? Okay, so like selling a house. So for decades, it's been an article of faith in bank boardrooms that when it comes time to sell, at least a few willing buyers, a local rival, bank from a neighboring market, a regional institution, would step up with a palatable offer. As Lake City Federal's Odyssey illustrates, those expectations often aren't met these days. Every investment banker or lawyer has a story or two of unnamed institutions whose board and management believed a cadre of buyers would be ready to step up when the time was right, only to discover that the level of interest wasn't nearly as great as they expected. Most of the deals we're working on, it's one or two buyers at best, and in many cases, there's no interest at all, says Bill Burgess, co-head of investment banking in the financial services group at Piper Sandler and Company. For bankers and board members who put so much time and effort into their institutions, this can sting. It's like if you list your house and are convinced it's worth 1 million, but when you put it on the market, you don't get any nibbles at that price. I've seen it happen, and it's tough, added Christopher Olson, who's a managing partner at Olson Palmer, a Washington, D.C. based M&A advisory. He adds, people look like they've been hit by a truck when the interest in their institution isn't as great as expected. Yes, I would concur with that assessment. The relative dearth of buyers is especially acute in rural America, where many banks operate. It is delaying executive retirements and forcing some selling banks to make compromises and change tactics. Some are getting more creative and structuring deals to meet buyer needs. Others are sitting down with buyers, such as credit unions, that not long ago would have been considered taboo. So this shortage of buyers makes efforts to prepare for a sale more important. Yes, absolutely. I absolutely agree with that. So many bankers and boards resist thinking about selling or don't act for fear of spooking employees or customers until the decision is on top of them. They don't take the time to update credit files, tweak business models, or resolve regulatory disputes, and sometimes sign long-term data processing, also known as DP contracts, with termination fees that make deals prohibitively expensive to execute. So a lot of key things right there in that paragraph. So many bankers and boards resist thinking about selling or don't act for fear of spooking employees or customers. That's absolutely right. I mean, if you're going to sell your bank, probably the last thing you're going to do is you're going to tell your employees and you're going to tell the customers that you're selling the bank. You don't want to do that. Why don't you want to do that? Because a whole bunch of your employees are going to leave and a whole bunch of your customers are going to leave because they're going to be like, well, what's the point of sticking around? You guys are going to sell the bank and most of you guys will be gone because you're either, taking a big fat payday and you're leaving, or, maybe you take a job working in another bank, or maybe you do stay on with the institution that's buying, but maybe you won't have the same level of power within that organization. It's like in other words, if you've been dealing with the chief lending officer, he might just be, a relationship manager after the merger is completed, that kind of thing. So, and then it goes on to say here, M&A advisory. Advisors say gussing up the bank prior to a sale by tying up loose ends, locking in key employees, and ensuring that there are no surprises can boost the odds that a seller gets a good result. There's a whole category of things that banks should be doing 2 to 5 years ahead of when they might want to sell, but most don't. They'll wait until there's a catalyzing event. The CEO wants to retire, the board or shareholders want liquidity, and suddenly says, hey, it's time to sell the bank. By that time, it's often too late. Robert Fleetwood, a partner at Barak Ferrazzano, Kirschbaum, and Nagelberg in Chicago, gives clients a 10-page pre-transaction checklist that includes cleaning up regulatory concerns and balance sheet issues, proactively addressing vendor contracts, and tweaking the business mix. It's like putting your house up for sale. You want to give the living room a fresh coat of paint and fix any plumbing problems, Fleetwood says. It'll cost you some, but it can make a big difference when it comes to attracting attention and getting the kind of deal you want. Yes, I would agree with that. I mean, there are definitely a lot of things that you can do. Like, I mean, definitely make sure you don't have any regulatory problems. If you have some balance sheet issues, try to clean them up as best you can. Just cleaning up some of the other odds and ends around the bank. Look at your senior management team. Like, what do their contracts look like? Are they, do you have them, like you said, do you have them kind of locked in? Look at your vendor contracts. Is there any way you can kind of limit the cost of getting out of those contracts if you were to sell the bank? There's all these kind of things, and these are all things that you can obviously work on very quietly without letting people know what is about to happen. Fewer and pickier buyers. The days of an acquirer buying 3, 4, or 10 smaller institutions in a year in a year are past. Today, deals tend to come one at a time with approval processes that can stretch well past a year. Most acquiring bank CEOs have a wish list of institutions they'd like a shot at and don't want to get encumbered in a deal for an attractive bank if their top target might become available. That's made acquirers more cautious. And yes, and I have covered the issue of how long it takes in a bunch of the M&A issues that I have done. I have covered that issue of the approval process and how long it's taking right now. I mean, a lot of people, a lot of times you're seeing this approval process take 18 months or 2 years. That's become a real issue. And then this goes on to say, like, there are deals that I would have done in the past, but I won't do today, says David Zalman, senior chairman and CEO of 38 billion Prosperity Bancshares, a historically acquisitive bank in Houston. You have to be more selective today because they may not let you do another deal for 2 years. In other words, absorption time. You got to buy the deal, and then you have to go through what's called the absorption period. You got to absorb that bank in, really get the whole thing integrated and everything. And that can take a little while. And until that appears like it's fully done and it's been successful, like you said, the regulators may not let you jump into just running off and buying another bank. So they said, if we're only going to get a few bullets because of the regulatory environment, we have to save them for A+ deals. There's a pickiness among buyers that we haven't seen before. So, and then the question becomes, is this a trend or a mirage? So basically, whether this is a blip or the start of a longer term trend is subject of debate. Just 100 bank deals were completed in 2023. That's the lowest total in more than 30 years, according to figures compiled for Bank Director magazine by Piper Sandler. I have also reported on that in past M&A deals where I talked about acquisitions and the type of deals that were done. So, check out some of those other episodes if you want a little information on that. Not only have many of the most attractive banks been acquired, there are also fewer buyers left. Many of the banks looking to sell are small institutions in economically stagnant markets that sometimes aren't viewed by buyers as being worth the price or effort. The median asset size of a selling bank in 2023 was $175 million, according to analysis by Olson Palmer. That's too small to move the needle for many buyers, regardless of the price. And that is very true. Like, in other words, if you're an $8 billion bank or if you're a $20 billion bank, does it make sense to buy a $175 million bank or even a $500 million bank? No, it really doesn't, because as they say, the juice is not worth the squeeze. There's not enough in that. In other words, the money that you're going to spend on the accountants and the investment bankers and the lawyers and everybody else to put that thing together is just not. There's not enough of an impact there with what you're going to spend to really make that worth your while. There's also some broader discontent about the effectiveness of deals to deliver value, and this is extremely important. Stephen Scoten, a managing director and senior research analyst at Piper Sandler, says he's noted some buyers who have been disappointed in both their returns on recent deals and the reaction of shareholders. There's a growing belief that buyers never really get what they thought they would get out of a deal. Investors' appetite for M&A isn't what it used to be. Olson argues that the industry's ongoing evolution is simply making smaller banks less compelling to buy. What a lot of sellers don't appreciate yet is that the value proposition of buying a community bank is declining. When you layer in the cost of technology, compliance, regulation, and human resources with margin compression, banks don't make as much money as they used to, he explains. There's a sense that the earning stream for banks has been dampened almost permanently. That can make things more difficult for someone trying to sell. So again, a lot to unpack there. Like, I think it's really important to understand that most mergers that go through do not turn out, like, they may not be bad, but they definitely do not deliver the value that you think. In other words, you get all these projections from your investment banker that basically say, like, oh yeah, well, if you cut these branches and you cut out these employees and you do this and you do that, you'll recognize this much gain on this thing within just a couple years, and you'll earn all your money back and it'll be great and everything. And it all looks good and it sounds good or whatever, but then when you get into it, it may not work out the way that you think. Even despite making all the changes and the reductions and the cuts and getting rid of some branches and getting rid of some people and all that, it still may not deliver on the value that you think. And why is that? Well, maybe the book of business that you're buying isn't as great as you thought. Maybe the deposit base isn't as solid as you thought. Maybe you lose some key lenders who go to another bank and take a huge chunk of the business with them. There could be a myriad of different reasons as to why that is. I'm just saying that for the most part, I want to say more, definitely more. I might even estimate maybe 60% of deals out there, that mergers that get done, don't deliver the expected value that you're looking for a lot of times. But I do disagree with this one point here, this idea that there's a sense that the earning stream for banks has been dampened almost permanently. Whenever we're in a market like this, where you have net interest compression, and bank earnings start going down, and regulation is getting high. People always say, like, oh, this is it. It's kind of like a doomy and gloomy kind of thing. And I don't really buy that, because I've been through a few of these cycles. Things can turn around. If a different administration comes in, that maybe tones back the regulation a little bit, the economy starts rolling. All of a sudden, that margin compression, will start to reverse itself. Banks will start to make more money, and then valuations go up, and then banks start selling again. It's like, it's just a cycle. It's what happens. And then, okay, here, compromises and concessions. So such factors have led to a growing backlog of bankers looking for an exit. Many have already stayed longer than planned and are feeling antsy. Some have underinvested in systems and are struggling with AOCI issues and don't see a way forward in the face of shrinking net interest margins and higher operating costs. Yes, this is very true. I don't think the underinvestment in systems, that is not as big a deal as the AOCI issues. I've covered before what the AOCI is that's a bank's investment portfolio. And I've covered basically the potential for unrealized losses in bank bond portfolios. And there's a couple of episodes I have out there on that. And that is a major, major thing, because what happens is, if you've got unrealized losses on your balance sheet, they may not be affecting you right this minute. However, if you go to sell the bank, those losses are, guess what? From an accounting perspective and a very real perspective, those losses are now getting locked in, because they're going to have to liquidate those. They're going to have to liquidate those and lock in the losses. And that is going to mess up your numbers big time. And that, I think that is a major, major issue that a lot of banks are having problems with. I think a lot of banks would like to buy certain banks, and a lot of banks would like to sell. But then when they sit down and they look at the balance sheets and they look at these AOCI, and they see that, they're like, oh my gosh, if we lock in these losses, this just kills the deal. And that is a huge, huge issue. And there it says right here, they're essentially looking for a buyer to fix their problems, but there's elevated compliance risk because they haven't spent money on the back office or don't have the right personnel in place. In some cases, the buyer is willing to do that, but often it's too much work. The current environment, coupled with institution-specific challenges, can force sellers to make concessions they might not want to make. Dan Bass, managing partner of Performance Trust Capital Partners, says he is working with an M&A client that saw its AOCI figures worsen in the middle of a deal. Both sides want to move forward on the transaction, but the deal structure and math need some tweaking. We're trying to figure out how to take some of the risk off the table for the buyer by having the sellers take on the additional AOCI risk from announcement to closing. Yeah. Good luck with that. That's funny. He's funny. He's got a sense of humor. It's funny. Okay, so Bass says in 2023, 11% of all bank acquisitions were by credit unions, according to S&P Global Market Intelligence. I have covered a little of that also in other episodes. A decade earlier, that figure was less than 1%. Other buyers in recent years include fintech firms and less traditional banks, such as community development financial institutions, CDFIs, which often receive government capital to support lending in underserved communities. In 2023, 23% of banks sold to a company other than a traditional bank or thrift. In 2013, the figure was 8%. So that's very interesting now that, we have other potential type of buyers out there other than just traditional banks. Like I said, you got credit unions, you got fintechs, you got these CDFIs, so that makes it very interesting right there. So, and then it goes on to say, it talks about how, selling to some of these other things or different avenues. And then now it gets down to kind of boosting curb appeal. The idea of making the bank more attractive for sale isn't revolutionary, but few boards put much effort into it. Short-term fixes and window dressing can be sniffed out quickly by experienced acquirers, but Olson estimates that up to 80% of potential sellers do little or nothing to prepare themselves in advance for Judgment Day. Yeah, I wouldn't disagree with that. Efforts to proactively enhance the institution's curb appeal can be a critical differentiator when it comes to attracting buyers in a challenging M&A market. And then at the very end here, it says, okay, at the very least, Burgess suggests getting a 2 or 3 year head start. You need the maturity to say, we're likely to sell or merge with another institution in a few years, and then work backwards from the anticipated date to ensure that you'll get some return from the investment. Proactive steps that boards and management teams can take to make their bank more attractive for the eventual sale include tightening data processing contracts, addressing regulatory issues, locking in key employees, cleaning up credit files, gussying up facilities, and planning for the transition. Here's kind of an interesting one. I want to just look at locking in key employees. So making long-term contracts and non-compete clauses a regular part of doing business well before a sale can help avoid raising employee concerns. Many banks have 1 or 2 loan officers or a market president whose loss would significantly hurt the bank's attractiveness to potential buyers. If your biggest lender is critical to your success, you need to lock that person in. Okay, couple big things with that. Non-compete clauses. If anybody's been paying any attention to what just happened with the FTC, non-competes are done. They're done. They got challenged in court. The court shot it down, basically saying that, no, it's upheld. So non-competes for the moment are basically out the window. You're not, if you have non-competes with your employees, they're basically null and void. You can't use them. They're done. Toast. And I think that's a big issue. I don't think that's a good thing. I think that's a bad thing. I think that can definitely hurt a number of industries out there. So I don't think that's a great thing. But now, and here's the other weird thing. It's very weird to see market presidents or lenders get employment contracts. And, that might be, maybe there'd be some situations for that, but I'm just saying in my experience, it's not the norm. It's not the norm that those people would get contracts. So, could you do it? Sure. But would those people be willing to sign? Maybe not. I think it depends on obviously the money, the situation, a whole bunch of factors there. So just as, like I said, just something interesting I wanted to point out there. So, but I thought this article was really, really good. I thought it pointed out a bunch of the things that were going on in the current market environment, things that banks need to think about if they are going to sell, but all, potential different buyers they could sell to, but being realistic about the market. Do you have a buyer that's there, or are you going to have to cut back? there's just a lot of great things to think about in that article, and also points out a lot of reasons why some mergers don't happen. A bank hasn't invested in compliance and in the proper people and back office. They haven't addressed regulatory issues. They haven't fixed balance sheet issues. They haven't kind of put the window dressing in, so to speak. They haven't spent enough time preparing for the sale. They think that magically, when it comes time for us to get ready for a sale, boom, that buyer's just going to be right there, and that's not necessarily the case. So, but anyway, I thought this was a great article, just highlighting what was going on in the M&A market from a different perspective. Instead of just looking at numbers of transactions, we're really digging into some of the core issues of what's really going on there right now. So, but anyway, I will wrap up now. If you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please make sure to leave any comments down below. Remember, we are on YouTube, Rumble, and all major podcast platforms. And please make sure to check out some of my other episodes. I've got a lot of great content out there on the channel right now, such as the Lords of Easy Money series, if you have not seen that. And always check out the weekly banking update, as that is the main show for the channel. And I will see everybody again real soon. Have a great week.